Good morning, everybody. Hello, and welcome back to your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledn, and as with every Tuesday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, November 2nd, and we have a jam-packed episode for you this morning. In today's issue, we're going to start by looking at what is next for Bitcoin ETFs in the US. We had some really great performance out of the first two that got approved, and we're going to look at what might be up ahead for potentially new Bitcoin ETFs in the US. We are also going to be looking at the US equity markets. Major indices last week roared to new all-time highs on the back of strong corporate earnings. We're going to be looking at what might lay ahead for those markets. And last but certainly not least, the Fed could confirm tapering plans as of tomorrow. They're starting an FOMC meeting today, and we're going to be looking at what we may expect out of that meeting. So grab your coffees. It's going to be a great one. And before we got going with today's show, we wanted to share our most recent promotion, which is our one Bitcoin giveaway. So we at Ledn are giving away one whole Bitcoin in the month of November, and we're going to tell you how you may qualify for this giveaway. So this last Sunday, to celebrate Bitcoin's 13th birthday of the white paper, Ledn announced that we're giving away one Bitcoin to a lucky client, and that could be you. To qualify, a client must ensure that they have a verified account at Ledn, refer a friend using your referral link, and that is the link you will find when you navigate to the referral section of your dashboard. You'll be able to copy it and share it by clicking right here. Before November 30th, your friend that you referred must deposit a minimum amount of 75 USDC or 0.0015 Bitcoin. The more people you refer by November 30th, the greater your chances are to win one Bitcoin. So you can share your referral link to your friends and family and start getting them to follow the necessary steps to get a chance to win the one Bitcoin giveaway. And the winner will be announced on December 1st through our Twitter accounts. We will be inviting the winner to record an interview, which we will later show on our social channels. And you can find all the terms and conditions for more information in our blog. And just to clarify, only residents of the following countries can qualify for the giveaway. And these are residents of Canada, excluding Quebec, Chile, Colombia, Mexico, Venezuela, and Paraguay. And there is no purchase necessary to participate. So check out the details on our blog and start sharing to get a chance to earn that one Bitcoin. And starting as we usually do with Bitcoin, we see that Bitcoin closed a week of low volatility at the top last week, and it finished last week up 74 base points, so 0.74% at 61,359. That's what it closed at on Sunday, but we already see it so far this week. It is up essentially 4.48%, trading currently at $64,097 right now. Now, as we can see from this little graph or these trend lines that we've laid out here, Bitcoin has continued to consolidate around this rather tight price range after rising from the mid 40s. And it has been, again, consolidating within this range of a high of around $67,016 right here, and a low of basically $56,425. And now, as we can see here, as it has been consolidating for these last 2 weeks, we're seeing actually higher volumes during this consolidation than we saw during the 3 weeks rally to the upside. And the other interesting thing here is that we're seeing the pattern that we're seeing here is often defined in the technical world as a bull flag. As you can see, this would be the mast right here, and these two lines would make up the flag itself. Now, from a technical standpoint purely, and just looking at the theory behind this, these types of formations tend to have positive continuation. We're actually seeing glimpses of that as it looks as if this weekly chart wants to bust out of this flag pattern. So we'll continue to monitor this throughout the week. Now, stepping back for a second, this isn't the first time that Bitcoin has traded in the $60,000 range. And now while this isn't the first time, the price volatility has been much lower this time around. Like just if you compare the range in price at which we are trading now after reaching the 60, and you go back and you just compare that to how volatile it was last time we actually touched that same level, we can see, at least visually, just from this chart, that it seems that Bitcoin volatility has been gradually going down as it continues to clear all-time highs. And in fact, that is actually the case if we look at the volatility spikes, and let me just pull up the skew chart to look at the volatility of Bitcoin over time. And this is a pretty fascinating chart. So here it is. And here you see essentially the realized volatility for a 3-month period in Bitcoin dating back all the way from essentially August 08 of 2013 and pretty much all the way into today. So as you can see, Bitcoin volatility has been, the volatility spikes that we see have actually been making lower highs since 2014. If you can see here, the trend is quite clear, and that is downward sloping and to the right. Now, this volatility graph that you have on your screen right now is theoretically exactly what you would expect from a new asset that is undergoing price discovery over time. As the asset matures, it should become less volatile. And we can see here that it is trending in the right direction. Now, as we mentioned in our last issue, just turning the page for a second into the Bitcoin ETFs, the Bitcoin futures ETFs last week in the US underwent their first futures contract expiration and rollover last week. So as we covered, these futures can only hold future contracts in the CME, and they cannot basically let these future contracts expire. So they must basically sell them right before they expire and repurchase them or replace them with futures contracts that are further out in the curve. So setting that, both BITO, the ProShares ETF, and BTF, the Valkyrie ETF, they both had to sell their October expiration contracts last week and replace them with either November or December contracts. Again, October contracts expired last week, so there was physically no other option. Now, we want to share the breakdown of the composition of the contracts and the rollover costs for the BITO fund, and this is courtesy of Athanasios Sadofagis, Bloomberg analyst, Bloomberg ETF analyst. And as you can see from the chart, which is quite fascinating, Bitcoin's October contracts, so this is the blue line here. The blue line peaked essentially on October 20th. The amount of October contracts that the fund held peaked on October 20th. And it started aggressively declining after October 25th. Again, last week, makes complete sense. Now, parallel to that, we saw that the number of November contracts that the fund holds essentially did the exact opposite. They were ramping up as they were unwinding their October contracts. As you can see, and if you do the sort of math on the different prices of each contract as the fund did these trades, by Safogari's calculations, the total cost of the rollover alone from October to November was 11%. That's basically money that had the money and premiums that the fund has to pay just to be able to hold these contracts. Now, again, we've covered this at length in previous issues. And while this highlights the relative underperformance of a futures-based ETF relative to spot prices, the range of possibilities for ETFs is actually quite broad. For example, there are 2x ETFs, 2 times ETFs, like the SPUU. And let's just pop this one up for a second to show you what the difference is. So this is the standard S&P 500, the regular index that a lot of people know. And we're going to compare that with what the Direction Daily S&P 500 Bull 2X shares ETF returns are. And again, this is a fund that uses leverage to get more exposure to the same underlying asset. So as you can see pretty clearly, in this same time period, the S&P 500 has gone up 21.6%, and the 2 times SPUU index has gone up 46.49%. So again, very interesting to see how a 2 times ETF in the wild currently today operates. And again, this fund uses leverage to amplify the returns of the underlying assets. And again, clearly it does outperform the underlying asset if you compare it to just the basic index here. And so with that being said, the case has already started building for a leveraged Bitcoin futures ETF. The chart that we're going to share right now, this is courtesy of Eric Balchunas, another ETF analyst at Bloomberg. And this chart essentially shows how a 1.25 times ETF leverage and a 2 times ETF leverage ETF, how both of those options would fare against the spot price of Bitcoin. So again, with the blue line here being the spot index, you can see the white line is quite significantly above it, just in terms of modeling the returns. And so does the 2x. Like the 2x, and mind you, both of these funds, anytime that leverage is included in any of these funds, it means that the fund outperforms on the way up and on the way down. You can see that here in the earlier days of this model as well. So again, the leverage amplification element would certainly compensate for the rollover bleed problem that we've discussed here at length that these futures-based ETFs have. Valkyr actually had been quick to introduce a 1.25 times Bitcoin ETF application, which it had actually dubbed Leverage for Ants ETF. And that's, you see some of the articles that came out last week in reference to that. Now, however, this application was quickly withdrawn, which signaled that regulators are not quite keen yet on accepting any variations of this plain vanilla approach that they just recently approved. Now, digging deeper into the ETF and when kind of the structural implications of it, the ETFs have certainly elevated the implied premiums in the CME Bitcoin futures contracts. We're going to show that here by looking at the chart of these implied premiums on SKU. Just a second to find the correct one. Here it is. So this is the this chart here is the annualized rolling 3-month basis for the Chicago Mercantile Exchange futures. Now, as you can see, at the beginning of October, they were trading around the 2 to 3% range, just as early as October 1st. Then on October 21st, just right around the launch of the ETFs, we saw these implied premiums peak close to 16%. So quite an increase, almost 4 times. And they have now, we're seeing them now start to settle around the sort of 7 to 8% range. The high premiums, the high implied premiums on these futures generate a lot of demand to borrow dollars and stable coins to participate in these opportunities, which allows then lenders of those USDC and dollars to charge higher interest rates while these market opportunities persist. Moving over to the S&P 500, we see that most US indexes finished the week at all-time highs, largely on the back of strong corporate profits. So we see last week the S&P 500 rallied 1.60% or 1.6%, closing at 4,611 points. This week we see it again off to the races, and we'll talk a little bit about what we can expect this week with the FOMC meeting ahead. But looking at, again, Dow Jones, again, roared to another all-time high last week. It seems to be off into a new all-time high again this week. Looking at the NASDAQ, we see that it also rose by a whopping 3.23% last week. Again, all fresh new all-time high on this index, and it seems to have reached another one so far this week again. Now, just to reference what we had said earlier, which is the fact that this is an article from last week, or from Sunday actually, that talks about the S&P 500 and the Dow closing at records to close November, or to start November rather. And we see that the small caps are actually doing quite well as well. You all, the viewers of this show will know that we follow closely the Russell 2000 index. And we are seeing a very different story in the Russell 2000 index than we have on the major indexes. large cap stocks in the US have not participated in the rally since March. And we're starting to see that they seem like they're about to break out right now. But that seems to be clashing with the potential tapering plans that the Fed may announce later today. So we'll see if this turns into sort of a rejection and downwards, or depending on how the market continues to evolve, we have been continuously looking at this level to essentially signal a potential new part of a broad-based rally higher in equities. So again, we'll continue to monitor this very closely and share any insights. Typically, so just to speak a second about the Fed and what the FOMC meeting today, the implications that might have. Typically, markets tend to trade sideways or even drop heading into big Fed meetings. And this is basically, in a way, investors showing that they are cautious. They do not want to take high conviction investments before they know what the Fed is actually planning to do. Now, again, this time is not the same. We're seeing that the FOMC meeting starts this afternoon. Markets are roaring into new all-time highs. And in this time, strong corporate earnings and animal spirits, coupled with the desire to shelter investments from inflation, with all the inflation markers just soaring, that has been basically, these desires have been too strong, and they have now overcome essentially the potential fear out of the Fed meeting that may announce the tapering plans later today. Now, to speak a second about this, how this tapering decision could impact markets. This is a headline from CNBC last week that said that in the week ahead, the week we're currently in, the markets could be challenged as the Fed prepares to potentially reverse the easy policy. The Fed has openly stated that it is looking to start its tapering plans to reduce its U.S. Treasury government bond purchases by mid-November. And the backdrop currently, from a macroeconomic standpoint, is pretty textbook for the Fed to move ahead. Equity markets seem to be in good shape, and we just saw again that the Russell 2000 index, which tracks small cap stocks, seems to be finally joining the large cap rally, and is trading just at its previous all-time high from March earlier this year. This is potentially a good sign. The markets are all at or near all-time highs, all the way from large caps to small caps. Inflation also seems to be cornering the Fed. What appeared to be contained to a few supply chain issues, basically this inflation issue that seemed to be contained to very few segments has pretty much made its way everywhere. Even the Fed's beloved personal consumption expenditure index was up 0.3% month over month last week, or 3.6% annualized. This is a headline that was out in reference to that. And that number is a fresh 30-year high on that inflation index. High inflation or rising inflation, along with a tight labor market, sets the perfect stage for the Fed. This graph that we're going to share now essentially indicates that initial claims for unemployment insurance seem to have bottomed out and plateaued right around the 300,000 mark. While tapering is always a shock to the markets, this time the markets seem to be surprisingly prepared for it, and this may be the Fed's window to act. Now, the sustainability of the current corporate earnings and for how long the Fed can actually keep interest rates high deserves an entire additional issue, and we will be definitely getting into that in the weeks ahead. Moving over to gold, we saw that last week the prices of gold dropped by 50 base points, closing at $1,782 per ounce. We're seeing that a lot of that has been undone so far this week. We're basically trading at the exact same level that it opened the week prior, currently trading at $1,789, up 32 base points for the week. So pretty much almost making back all the drops from the prior week. The drop in gold on last week's, drop in gold was partially influenced by a rising dollar index. So in here we see that was a pretty big lift on the US dollar index, up 56 base points last week. And we know that can act as a headwind for commodities. On that note, checking in on oil's recent rally, Last week actually handed West Texas crude its first down week since August 23rd, which is quite remarkable. And it finished down just a moderate 1.03%. And like gold, it seems to have been holding on to some of these price levels after this massive run-up. It is currently trading at around $83 per barrel. Now, the week ahead, just turning our eyes back to gold for a second, the week ahead will be all about U.S. Treasury bond yields. These could soar pending the Fed's announcement to potentially taper its bond purchases program. If they do this, this will put pressure on gold prices to the downside. And why is that? As we know, gold has an inverse relationship with the real return of U.S. Treasury bonds. So if the Fed does announce its tapering plans, if it allows the rates for these interest rates for these bonds to start surging, and inflation continues to stay the same, that means the real return of these bonds will become higher, which should put pressure downwards on gold. Again, so we'll continue to monitor this, and of course the Fed announcements that'll come out tomorrow. Moving over to DeFi, we see that the DeFi index had a good week last week, up 2.65%, and it seems to be off to a great start this week, which is up 7.24% so far this week. Again, pretty positive action in the prior week and so far this one. Looking at Ethereum, we see that it had an excellent week last week. It reached a new all-time high of 4,460, and it closed last week higher by 5.06%, north of $4,000 at 4,288. We are seeing it actually reach a fresh new all-time high live this morning. So again, currently trading in uncharted territories yet, Ethereum. The DeFi index, just looking back at this, which is largely made up of protocol tokens, has very clearly been underperforming the layer 1 protocols like Bitcoin and Ethereum recently. And to illustrate this, we're just going to do a quick comparison here to Bitcoin and to Ethereum, and these are being compared right now to the DeFi index. And let's go out to the daily and basically find or move ourselves out until say May or October. But as you can see here, it's pretty clear that the layer 1 protocols like Bitcoin and Ethereum are quite outperforming the DeFi index at the moment. Now, this could be in part attributed to the market continuing to digest Compound's $160 million bug. So again, these protocols, this was a pretty big issue or bug, pretty meaningful bug that one of the major protocols experienced a few weeks back. And we also saw last week that there have been continued sort of high stakes hacks on young DeFi protocols. The one that you have on your screen was headlined from last week, which highlighted that the Cream Finance protocol on Ethereum had been hacked for more than $130 million. Now, we do expect this trend to continue favoring layer 1s over DeFi protocol tokens, unless the current speculative interest in dog coins takes a detour back to DeFi. And looking at our Bitcoin mining difficulty commentary, we saw that the most recent difficulty adjustment poetically landed on Bitcoin's Whitepaper anniversary last Sunday, and it brought difficulty higher by 7.85% to 21.66 terahashes, and we continue to inch closer to that hash rate all-time high of 25 terahash. The mempool, just checking in on it for a second, continues to be quiet. Transaction times and costs continue to remain at optimal levels. And as always, we wrap up with what we can expect for the week ahead. The week ahead will be all about the Fed. As we mentioned above, the environment is ripe for the Fed to act. Even if it cannot keep the rates high for too long, for reasons that we'll get into shortly, action from the Fed will send the market a signal that the Fed is not prepared to let inflation run away. Inflation is not an if anymore in the mainstream conversation. It has quickly shifted to a conversation about how high will it go and for how long. The Fed can put a symbolic end to that conversation by letting rates rise a bit and see how markets evolve. While markets seem strong at all-time highs right now, the third quarter GDP numbers out of the US were a disappointment. And there's a lot of accounting in the current corporate profits. Namely, many companies rely on first in, first out accounting, which means that they are booking today's sales with yesterday's inventory costs. This can only go on for so long, as they will soon have to mark those sales to market with current inventory restocking prices, and this will compress their margins. All this to say that even if the Fed does raise interest rates or lets them start rising, it may not be able to do so for too long. As always, we wrap up with a summary of the important and relevant economic data that you can expect throughout the week. So on Wednesday, tomorrow, 2 p.m. Eastern, the Federal Reserve makes a statement out of its FOMC meeting, and followed by that at 2:30 p.m. Eastern, Fed Chair Jerome Powell also gives a press conference to talk about further about the Fed meeting. On Friday, we get non-farm payrolls in the US, we get the unemployment rate in the United States, and we get average hourly earnings for US workers. This all happens at 8:30 a.m. Eastern on Friday. Now, this is a big day of data for the labor market, and the expectation here is for the job side of things for non-farm payrolls to increase by 450,000. Last month's report was dismal. It only added 194,000 jobs, and most people are expecting a big comeback here. So the risk is likely to the upside, as a miss would be considered good news by markets. Again, we're still in the bad news for the economy equals good news for the markets scenario. Looking at the unemployment rate, that currently stands at 4.7%, and it is expected to rise to 4.8% in this report. The labor market has been showing signs of exhaustion, with the pace of gains tapering down recently. More signs point at the fact that the US is reaching its new natural rate of unemployment, and that essentially the Fed should be more quick to act to not let rates can remain low beyond having reached the natural rate of unemployment. Now, on the plus side, for Friday's data on US workers' average hourly earnings, these are projected to have risen by 0.6% month over month in the month of October, which equates to a 7.2% increase annualized. So, big week coming up, and as always, we'll keep you posted with any relevant information right here and through our social media accounts at Hodl with Ledn. If you enjoyed today's show, if you learned something, and if you liked it, I welcome you to thumbs up it and like it at the bottom and share it with your friends. And you can also subscribe to our channel. If you don't have a Ledn account, I welcome you to check out ledn.io and start earning up to 6.25% on your first Bitcoin and 9.5% APY on your USDC. We also have the best rates for Bitcoin-backed loans if you need liquidity but don't want to sell your stack. And we are giving away one whole Bitcoin for the month of November for those people that refer. Some conditions apply, so do check out the details in our blog. Thank you, everybody. Have a wonderful week, and see you next Tuesday.